you very much for joining me. This is the morning market review. It's Tuesday, it's the 5th of December. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Just going to go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. Good morning, Kim. Nice to have you on the webinar. Thank you for joining. Thank you everyone for signing in this morning. It's much appreciated. Hello, Raj. Good morning, James. Pleasure to have you on the webinar. Just going to keep this high risk investment warning on screen for a few moments longer. All right, let's just go ahead, bring up our market commentaries disclaimer. And here is our references. It's MarketScope 2.0 and TradingView.com. And we'll go straight through to TradingView.com, and we'll keep an eye on the real rate. This is actually a different perspective of the real rate. Here, what we're doing is we're looking at the weekly chart, added some indicators, and you can see that the green 5-week exponential moving average has moved below the orange 10-week moving average. I'll just bring this to the front. And you can also see that the rectangle, you can see that the RSI is below the 50 as shown by the rectangle. I'm just going to make this easier to see as well. We'll make this a blue rectangle. So you can see that we're starting to dip below 50 now. What's interesting here on a weekly perspective, obviously it's a broader view than when we were looking at the daily perspective. The idea here is 50 is kind of the dividing line. If it stays above 50, which it has been since May, then there's going to be sort of an upwards movement. And then if we get some sort of sustained period below 50, the real rate is going to be pushed down. Okay, so that's where we're at. Now, I think everyone's fairly comfortable with our analysis starting off with the real rate. But we have to be very careful here, and this is something that we need to keep adrift of. Why is the real rate coming down? Why is it coming down? And there's, I think there's three possible reasons. The first reason is that it's overshooting to the downside, okay, and that it will correct back up. That's second thing is it's coming down because inflation's coming down. There's a disinflation, and the third reason, and this is one that is we're going to have to watch the data, is it's actually starting to come down because it's starting to price in a recession ahead, and they've all got very different repercussions for us as traders. So if we go through to the daily chart, okay, let's take out the indicators. What you can see is that we've got a peak. Here's the trough. Let's make it a capital T. Here's your lower peak. And here's your lower trough. Okay, now the idea here is why we're spending so much time here is because this is really what's driving the market, the real rate. And at the moment, the real rate has largely been driven because of a disinflation catalyst, so to speak. And what that has effectively done, it's weakened the dollar. So if you take a look here, we'll put the dollar underneath. Okay, put the US dollar underneath. And you can see, let's put in the peaks and troughs here. So you've got a peak. See, it's similar, right? Here's the trough. Here's the lower peak. Here's the lower trough. Now, this is because of the disinflation. What's happening here is that the dollar is actually picking up slightly. You can just picking up over here. It's picking up here. And the question is, why is it picking up? Because the real rate is moving down. I just want to keep an eye on this, by the way. In other words, is the market suggesting that the real rate has come down too quickly? If you recall, the communication out of the central bank about a month ago or so was, well, the higher rates are doing a lot of the tightening for the central bank. What if that's the case? Those rates have come right down over the last month. So is the market now doing, is it too loose? Does that mean that the Fed is coming back to say, look, we're going to have to tighten up a bit? I think that's a little bit premature to say, but the point is that the dollar is showing some signs of movement up here. I just want to keep an eye on the interplay between the real rate and the dollar, because it has effects for us as traders. If we start getting real rates coming down because of recessionary fears, the dollar may actually stop moving contrary to what we used to. It may be moving up. Why would it be moving up? It's a safe haven because of recessionary fears. And we might see that the stock market actually comes down, even though the real rate's coming down. So that's what I just want to make sure that everyone understands what I'm saying. I'm saying we're at a situation here where we're seeing the real rate coming down because of disinflation. We're going to have to watch the data now to see if that is going to maintain or if that story is going to change in 2024. If we're going to see recessionary fears, then the correlations are going to change. It's going to change our whole strategy that we used to in terms of basically the correlation coefficient. Does everyone sort of understand the change in theme that we're talking about here? It's really important. Okay, it's going to certainly be something that will affect us as traders. We're going to start looking at potential opportunities now. Just be very cognizant of the fact that the correlation coefficient is a strong, robust, positive 82%. If we start moving towards recession, this correlation can actually drop negative, and we might see, okay, you'll have to email me, Kim. I don't know why it's showing 4%. That's not right. So you'll have to email me there. All right. All right. Let's take a look at some opportunities. Okay, going now to MarketScope. And let's just see if there is opportunities here. Again, the US dollar has been really strong. I think it's now strong this week. I've got to be careful what I say, right? We've got this big blue candle. It's only Tuesday, right? So is this the rally in the downtrend? We go through to our daily chart, and you can see that we had a strong day yesterday. I'm going to just extend this. Put the potential lower peak here, and now we can just see if is going to be some sort of interplay with the short-term resistance. Go through to your hourly chart. Let's see what's going on here. All right. Okay, so by and large, we're heading towards the R1 level. Let's what we can do is mark the R1 level as the level that we're now going to keep an eye on. Okay, and the way this would look, it would look as 1, 2, 2, 3. Okay, and then if there's going to be some sort of movement over here. Now, I don't know if that's going to be the fact. Remember what we say in this webinar is that we don't want to predict, okay? We want to react. So I don't know if that R1 is going to be a reaction level. What I did say yesterday is that this level looked to be the resistance level, and it kind of did hit it and bounce off, hit it, bounced off. Now it's looking to sort of try and challenge this resistance level. I think there is still some influence here. The question is, does the R1 level come in? And if the R1 level comes into it, is it going to act as resistance? Okay. Now, take a look what's happening to the stochastics. Stochastics moving to the 80 area. Now, why is there money? Listen to this question. Why is there money flowing into the US dollar? Yeah, the real rate's coming down at the moment because of a disinflation, in my opinion. Okay, so why is there money flowing into the US dollar? Kim's got it. He's saying a safe haven. So now the next part of the question is, well, why is money flowing into the safe haven? Why is money flowing into the safe haven at this particular point? And I think for that, what we can do is the best. We'll go through to the Dow Jones Industrials first. Let's just go through to the Dow. Okay, and the reason that we are seeing money potentially going through to the safe havens is because we're just so frothy on the risk markets at the moment. Look how overbought the Dow Jones is. He is really showing a severe overbought condition. I think that this overbought condition is making the analytics much more complicated because just going back to the US dollar here, what is that we've got a nice ordered trend, but now is this a lower peak? Well, it's looking to push from zone 3 into zone 2, and I think that is the market saying, well, look, it's time to take some profits. We've had a terrific run on the stock markets, and you can see that the Dow here has had a terrific swing, but we've gone very overbought. Let's take a look at S&P 500. Okay, all right. S&P 500 correcting some. So this is interesting to see. So we were overbought here. It's now coming back down into normal territory. I like that. Okay, but the Dow Jones, that industrial component, not quite there yet. Let's take a look at NASDAQ, see where the NASDAQ is. Okay, Nasdaq coming down quite nicely. All right, and let's just take a look at DAX as well, just to see how the overbought condition on the DAX is doing. Okay, the DAX, so DAX, which has sort of got a heavy industrial component to it, still showing signs of overbought. So the industrial side of the market looking very frothy, and I just wonder if that is what's causing the flow into the US dollar in the meantime. What I would suggest is that we're right at sort of a key reaction level here. Okay, the question is, are we going to get the US dollar reacting? Okay, don't predict, react. We want to see if we're going to get a rollover in the moving averages, and we want to see if we're going to get a rollover in the stochastic. If we get the rollovers, okay, let's see if the other majors are giving us any potential entry points. Let's take a look at the euro. Does the dollar and the Dow S&P have an inverse correlation? There would be an inverse correlation there, because the dollar would be regarded as a safe haven. The Dow Jones, S&P 500, Nasdaq would be the risk side of the market. So there would be some sort of inverse correlation there, yeah. Raz just saying, look, let's take a look at the negative divergence here. Okay, so that's a good spot there. So we want to see the dollar, does it react at the price resistance or the R1 level? So we've kind of got this with the level as such. If the dollar pushing up, if the dollar is pushing up, okay, no surprise to see euro pushing down. Let's go through to the euro. Okay, you can see the euro is pushing down quite heavily. If you take a look at this on the weekly chart, we are above the 30-week exponential moving average. The 30-week exponential moving average is pointing up, flattening. The RSI above 50, but hooking, okay? And gee, the euro's really pulled back somewhat, to the point that we've dropped through to the lower 50. I don't like this chart. It's looking too much in the neutral area. Okay, let's take a look and see if we get a better reading on cable. Okay, cable perhaps giving us a little bit more to work with. So here we've got stochastic above the 30-week exponential moving average, the 30-week exponential moving pointing up. The red here showing a potential dip in the uptrend, not nearly as compromised as the euro US dollar. Okay, so we just want to see if there is some sort of support that comes in here. And what we can do is we keep an eye on this level. Okay, and I'm going to extend it through to the S1. So we want to see if the S1 level holds some sort of support. James saying, what's the reason for the euro drop? I think what we can do here, James, is we can take a look at it in terms of the calendar. I just want to see if there's anything that's come out, and then I want to take a look at it in terms of the spread between the yields. Let's see if there's anything. You can see French industrial production missed quite severely, came in at a negative 0.3%, and the forecast was for a positive 0.2%. Let's just take a look, James, at the spread. So what we'll do is we'll change this to, instead of the US dollar at the bottom, let's make this Euro US dollar. Okay. Okay, so you can see the drop in the euro here. And what we'll do is we'll make this the German 2-year minus the US 2-year. So now we're looking at the short end of the yield curve. We're looking at the spreads, and we want to see if there is some sort of correlation there. And you can just see here that the spread has dropped. Let me put in some arrows there. Okay, so the ECB meeting next week. The question is, what's it going to do? What's the ECB going to do? James, in my opinion, the ECB isn't going to do anything in terms of changing its rates, but the economics in the euro area perhaps suggesting that they should. Okay, in that there is much weaker economic data coming out of the euro area, and I think that's what we're seeing in the spread with the German 2-year really pushing down against the US 2-year. It looks as if the market suggesting the ECB becoming the more loose bank than the Fed. So that's possibly one sort of explanation there. Let's just take a look at the 10 years here. Which would be more investment related. It's not quite, it is there is some sort of capitulation here. It's just the economics in Europe seem to be driving the euro lower. I'm hoping, James, that sort of makes some sort of sense to you. So yeah, money flowing out of the euro, potentially looking for that safe haven dollar play at the moment. This is an interesting setup that we're seeing here. Remember, we started this webinar and we've been talking about is recession coming into the US, because that's going to change a whole lot of the correlations. So the fact that we're seeing the movement in the euro here, now that's very, very interesting. So we're just going to keep an eye on that. Okay. All right, let's just take a look at gold as well. I want to just bring that up. This has really been a good chart to monitor over the last few weeks. Just going to go through to gold. And I think what's happened here is gold just was this overbought condition here. This overbought condition just got ahead of it and pulled back. Remember, we saw froth in the S&P 500 and that's pulled back. I think this is a similar type of technical pullback, and just that money going into the US dollar, which makes sense. But I think that the pullbacks here are potentially supported around the 2000 area. So let's just see if this area, which is a psychological level, offers some sort of support for the precious metal, for the yellow metal. All right, that's as far as we go this morning. If there's any questions, just go ahead and type those in. Any questions? Tomorrow we will do 2 webinars. We'll do the morning market review, and then we will crossover and do the crypto minute. Thank you very much for joining this morning. Have a really good day ahead, a good evening ahead, and we shall chat tomorrow morning. Thanks very much, guys.